My name is Michael Gaia, publisher of the Lead Lag Report. Joining me for there is Mr. Jeff Macke. Jeff, it's been a while, I think, since a lot of people have seen you do the media runs, but introduce yourself to the audience. Who are you? What's your background? What have you done throughout your career? What are you doing currently?
Well, the moment I'm talking to you, and I'm happy to be here. It's nice to see you again. You're probably right on Yahoo Finance. I did a Yahoo Finance. I was on CNBC back in the day, like 1998. I started a hedge fund, operated that for 7 years, then gave it up and have been managing, advising select clients, making private investments, and just running my own book, primarily in the consumer space and just retailers in general, which has been very exciting 5 years ago and kind of dead money or a little quiet over the last few months. And seems like it's time to get out there and talk about them again. I think they've built a little bit of a base. So I'm just putting my own money to work and just happy to kind of peek my head up again. It's nice to talk to you.
So why the focus on consumers and consumer stocks?
Well, the big idea was that we had a real generational transition. It's not a fresh insight particularly anymore, but as we moved online, it changed the space. Retail is really just distribution. If you go back to Sears, what they did was just set up distribution centers around the country, and they became the Amazon of their day. You get these generational transitions. Once Amazon disrupted this space, they figured out a better way to distribute. That disrupted this space. We saw that migration going on at a fairly good clip, outpacing the growth that you would see from the physical brick and mortar chains. That slow disruption became just a tsunami through COVID. And I'm not telling anyone stuff they don't know, but between the free money and just the flood of goods that you had, people buying online, that accelerated that entire adoption to over 20% now of all retail is conducted online. That number is still growing. And we've seen this just divergence between the chains. The ones who kept up are thriving, and you have stores, the Targets of the world, they've kind of been left for dead, and their models become a little antiquated, and they're trying to find their place in this new world. But it all has to be put into the context of COVID, because that changed everything. That was absolutely the most disruptive moment of retail. And it's going to have a compounding effect for kind of the rest of our lives, at least in terms of the way people shop and they go about their day-to-day business. And so that's kind of a long way of answering consumer space, because there's got to be money in that trade whenever you're transferring $1 trillion from one channel to another.
So it's my sense that, just because you mentioned the Sears example, and the idea that it's around distribution, that whereas that was the real edge, let's call it back in the day, the edge now changed to, the retailers which have the most large data, the most advanced, AI regression type of models to try to predict consumer purchasing behavior. How has the technology side changed for retailers, and how is it both an advantage and a disadvantage for broader consumer bargaining power?
Those are two different things, but nestled within that is the idea that Amazon, what they've really been able to do is, again, through the distribution, what they've killed Target with and what they've really accelerated their game, Amazon, over the last year or so, is same day or next day delivery. After going after it for ages, they kind of have quietly moved to more distribution centers throughout the country and smaller DCs in larger metro areas. But you can get things from Amazon now delivered basically same day, which, that is, it's a huge difference. Prime used to be 2-day delivery and it was not guaranteed. Now, for the most part, you're able to get mainstream goods the same day, which takes the trip to the store out of the equation. Along with that, the stores themselves have become much less friendly kind of hangout places. You've seen a real shift societally in the way we spend our time. And it's created this dual class mall system where the shopping areas that have been able to keep traffic flowing, keep the violence levels down, keep the shrink problems down, are thriving. And then there's other malls that are just untouchable, and they're becoming sort of ghost towns and commercial space that has to be reallocated. But again, one of the main drivers of that, and the chief driver of that, is Amazon and their ability to get goods in the hands of their customers faster. And they've been kind of playing a little game of hold up the shiny object and look, we're going to do drone delivery. But they've been doing it really old school with just trucks and distribution centers to get your stuff out faster. And that's been the difference for consumers. People aren't patient. They want it now, but 2 hours is close enough.
Do you think that edge becomes a little more dull, given Instacart and other kind of delivery services that act as more of a middleman across different retailers?
That's going to cost the retailers quite a bit. So you have the lawsuit with Amazon going on right now. They're grabbing share. What they're doing with the third-party vendors is they're extracting that huge amount of profit. Now, Amazon, because they have the distribution and because they're a retail face, that is their own proprietary Instacart. And so it's not really economically viable to be using those third-party systems. Something's got to give in the gig economy. Uber just missed today, which is somewhat related with the Postmates and everything else. But, it costs money to hire a service to pick it up and have it delivered. Amazon's the lowest cost provider, and they're charging the most aggressive rates for the people that are doing third-party shopping online. It's Amazon online third-party stuff that Amazon's not selling, but just space that they're selling in their kind of virtual mall storefront is already a bigger business than Target. They did $36 billion, growing 20% a year, growing much faster than any other form of retail. And that's just third parties using Amazon themselves. So the Instacarts, the DoorDashes, you could pile them all up on top of each other and they're not going to be able to compete with that, which is what gives Amazon so much pricing power and why it's such a big deal when they're using the technology, as you pointed out and alluded to. They're using that pricing or that power to keep prices higher. And in fact, are making sure that they're not being undercut by these third-party vendors, which is kind of incredible because they're also charging nearly 50% of the gross margins for these retailers. So you end up with the sellers with the absolute lowest cost of goods sold taking share. And it's a flea market. They're not particularly well vetted vendors. And if you're someone like the Gap, if you're any of these retailers that are using their own fulfillment or their own distribution on the back end or using third-party operations, they're at a huge disadvantage.
One of the narratives that was put out there, I think especially post-COVID, was, you're going to see this ongoing transformation of retailers and stores in terms of being more about the experience of shopping, and the experience is now one where there's theft, as you kind of alluded to. I mean, we've all seen those clips of theft going on and just people just letting it go in plenty of places in California. I don't know why California in particular, but that's a whole different discussion. Have retailers just kind of broadly outside of the big chains, have they not been able to adapt to think about how do you bring more people in the store beyond just price and availability? It seems like that experiential part was talked a lot about as a theme, but never really came true.
And part of that has been, you get a few different drivers of it, but the biggest issue in terms of the theft and the shrink. Now that comes, we've seen the camera-friendly sort of the mobs that are going out there and stealing things. And one of the reasons that you see more of that from California is we all are kind of phone obsessed out here. But the other thing is that we don't prosecute. California, you can steal up to a certain dollar amount of property and just take it right out of the store. And it's gotten so much easier to sell it online that you have this incredible beast that you're serving, the ability to kind of move product from instead, 10 years ago, 15 years ago, if you stole a set of speakers, you would literally be kind of reselling it at a fraction of the retail price on the back of a van. Now you can get national distribution. And if you're doing it through someone like Amazon, you're actually incented as the thief to sell it close to retail prices. The margin has changed completely. And that's been driving this, that's where all the stolen goods, the shrink is just being sold online. Not necessarily through Amazon, but through a million different storefronts. That's changed the economics on the shrink side to the point that the stores are losing product pretty much throughout the supply chain. Shippers are complaining about it. Its entire trucks are being taken offline. It's not just the mobs that are stealing things. Shoplifting theft kind of breaks down to about maybe 5% of the stuff is lost. You get like at 30% shift between people that are just shoplifting and inside theft. That'll be someone within the supply chain that's diverting a truck, that's moving this product. And again, what's been the accelerant to that is it used to be this one-off crime. You couldn't scale the business of shoplifting into a lucrative little sub-business of selling it off on third parties. Now you can. And the stakes are so much higher that it's really it's a federal offense. It's just organized crime. It's organized retail theft. When you see that it's only 1% of the top line, that's misleading because it's about 20% of profits. You're talking about a 6 or 7% margin business. And for Target last quarter, they said they didn't even really give the number, but it worked out to about $250 million in profits. And that's a company that made $7 billion gross. So they just can't sustain that margin effect is too material to the existing stores for them to ignore. They have to resort to locking up the products. They diminish the experience of shopping in a Target. Now, and they've also executed poorly. So you have this self-check impersonal system. You've increased the theft, and you have to lock up all your product. And you go into those fishbowl stores. I don't know where you live, but it's any store where you go into and you have to find a clerk to unlock the razor blades so you can just buy the razor blades, which usually come in a plastic case so you can't use the self-check. That's a nightmare. That's an absolute disaster for the store. You diminished what it is to go shopping. That sort of hang out in the store, find something extra that really defined Target 10 years ago, 5 years ago. That's gone away. It's a less friendly place to hang out. So you are seeing kind of decreasing basket sizes, fewer impulse items, discretionary goods just don't get sold. And depending on how the stores are set up, Target's uniquely positioned as a victim. Costco, because of the club membership aspect and their checking IDs, has a little less of it, but Walmart's seeing the same problem. You're seeing bulk theft as opposed to just the one-off shoplifting, and that's really been what has hit the retailers harder. And the margins just aren't big enough. You take $500 million of profit out of Target, and that's material for them. It's a huge deal. They've stopped complaining about it so much. They become, but they're still just this battleground kind of store that people love to argue about. And that's antithetical to driving retail sales. You don't want to be controversial. Target should welcome everyone every day of the year.
Is that driven by just cultural shifts? I mean, I don't want to bring into the conversation kind of wokeism or anything like that, but it seems like there's something kind of generational that's also maybe happening with this.
Oh, I agree. I mean, it's Target right now is a battleground. Again, it's people just love to argue about it kind of in general. And they're either way too liberal and so they've offended people on the right. Any action that they take to kind of back off these statements that, again, as a general merchant, it's questionable whether they need to be making them anyway. But any moves that they make to limit that damage just looks like they're capitulating. So they tick off the left as well. All of a sudden, again, you're just trying to be a store for everybody. The idea of Target is nice. People like discounts too. It's inviting to literally everybody, but you can't even bring up the name without getting into an argument about it. I was actually talking to friends last night at dinner about doing this podcast, and they immediately wanted to talk about Target and what they should do. And part of that's because my dad used to work there, but the other is just, it's a controversial store. And man, controversy, that's fine if you're Guess. That's fine if you're Calvin Klein. You're selling kind of a hot, sexy brand. It's not good if you're a general merchant.
Yeah, I don't track it that closely, but I see it the perfect. But I'm blown away that we're at a point in the cycle of society, whatever you want to call it, where corporations become lightning rods for use in this way. I mean, it's just about selling stuff.
It's about profit and loss. Walmart does a much better job, and by the way, also closing stores and openly doing so because it's just too expensive. See, between crime prevention and the shrink itself, and you have wages going higher, all of it just adds up to a store that doesn't economically make sense. Target or Walmart just recently closed grocery stores in the Chicago area. And, before the criticism even brewed about any reason they did it, they said, listen, these are losing tens of millions of dollars. Well, that kind of ends the conversation. If you're locking up a store, the economics just no longer work. And for some reason, these stores get blamed for leaving the communities. And really, honestly, if you work it backwards, no company wants any part of that. They're not leaving the communities for any reason other than these just don't make economic sense anymore. And in many cases, as Walmart did, as Target does, they're subsidizing the rest of the chain with formats that just don't work. And so then it becomes news when Target closes 9 stores that have been in 2 or 3 of the ones they closed, the San Francisco store in particular. It's easy to bag on San Francisco. People crap on it all the time. Like, I used to live there. I'm kind of bummed about what's happened to it, but I don't really have a political axe to grind other than I couldn't walk into Target and feel safe. I lived in that city for 15 years. It's just, it was sketchy and they're losing money in that San Francisco store. That it is not a particularly complicated conversation. Their Target's earnings are down and they're running stores that lose money. It should be case closed. And yet they're kind of not doing it for whatever reason. It becomes so politically laden to make these obviously rational economic decisions. Now, every chain, whatever you think their obligation to the community is, their major obligation is to stay in business. You can't run a bunch of money-losing stores and expect to stay in business.
So speaking of that, that's a good transition to something that is, I think, going to be a bigger and bigger story, which is, you hear these narratives around zombie companies, right? These with razor thin margins, high debt, they're going to have to roll over their debt into higher for longer rates. Likelihood of survival becomes less and less under that. What percentage of let's call them public retail, public stocks, are at risk of really just not even being around anymore because of higher for longer? I've got to assume that a lot of retailers are legitimately on the cusp of maybe becoming distressed companies.
Oh, absolutely. I mean, you have the wave of all the kind of Chewies of the world, the Rent the Runways, all these kind of companies that made sense in a world of 0% financing where everyone was going online at once. And so they became the big hot thing. Even Etsy, which I've been long, I respect the way they run their business, but clearly that is going to be hard for them to be as socially relevant now as it was a few years ago. They're not anywhere near being a zombie company, but is Foot Locker in trouble? Absolutely. Did the process of COVID kind of speeding up it? It never made sense. The future of selling $500 athletic shoes was not some guy in a ref jersey disappearing for a half an hour and then bringing out the wrong size. It's a terrible way to shop for anything. It was always kind of a dinosaur business model that's been accelerated by leaps and bounds. And at this point, you're really in a situation where it's just a matter of time. I mean, if they don't stop the bleeding, they've got smart people. They've got a huge distribution advantage. They've got a lot of good things going for them. But the stock isn't particularly cheap and the earnings are still going lower. And it's not clear those business models make sense anymore. And so whether you call them zombie companies, there's a lot of companies that need takeovers. There's a lot of companies that I think if we had a lower rate environment, you'd already be seeing companies like Rent the Runway getting mopped up and just getting taken over. But right now, we're just still digesting. It's a story of two malls. You look at Victoria's Secret and Foot Locker versus Abercrombie and Fitch, which is crushing, doing amazing things. Gap, which is up 50% just for hiring the guy that did the Barbie movie, I guess. Macy's is higher. These companies seem to have bottomed, but there's other entire areas of the mall that are just dead. And there's too much space. Canadian Goose reported they have no idea why they missed, but they're still expanding store space. Now, they'll probably rent those stores from where Peloton locations used to be. Neither one of those companies needs stores. So as long as there's any kind of money, you'll have retailers making bad decisions, but it's definitely been not an investing environment that favored kind of buying the dips or buying the cheap retailers because they just get cheaper.
Yeah, I think that's the challenge. That's one of those disconnects that I keep stressing in my own research. I mean, I keep looking at the XRT retailer ETF, which is an equal weight proxy of retailers. And for all the narratives around consumer is strong, economy is booming, the reality is those stocks haven't done anything. So there does seem to be this broader concern out there around the likelihood of being an ongoing concern.
And there's just the digestive process. You look at someone like Lulu. I was just looking at him today. It's actually in the context of the Gap. You can find it on Twitter at Jeff Macke. Posted kind of a comparison. I mean, the Gap used to be Lulu. 25 years ago, it was the same situation where stores come around every once in a while and they just change the way people wear clothes. That's what the Gap managed to pull off. The stock reflects it. It's been dead money for 26 years, 27 years. Just crazy. Not necessarily a zombie, but just flat dead money. Lululemon, on the other hand, is kind of at the peak of its powers, the height of its mojo. The earnings have been spectacular. The numbers have been great. I mean, their execution just is what it is. And the stock has done really nothing for 2 years. And so the idea, it's, for all the debate about the consumer, I think they're just really particularly selective. And in a climbing rate environment where there's always headwinds with the consumer, what you've seen from Lulu for the last 2 years has been strong earnings, stock pops, and then it just gives it back over the course of the next 3 weeks. And that's honestly the best company you're going to see. That's the heavyweight champ of specialty retail for the last 5 years. And the stock is just dead money. So, it's, I don't know that the consumer's fine. I think it's, again, you have to put it in the context of COVID. So this is going to be a terrible Christmas. Most headlines are saying it's going to grow 2 or 3%, which is absolutely not exciting, but it's not the Armageddon either. It's just that you have a discretionary consumer that's more discretionary than ever, meaning they don't really respond to promotions that well. Lululemon is a full price store. They don't have to do any discounts. And Gap still is a place where they can mark things down 70% and usually do. And it's not going to really improve traffic at all.
You mentioned the Lululemon example. I haven't really done any work on this side. I don't know if you have, but what's the IPO side of things looking like when it comes to retailers? Is there anything that recently has become a public company that looks particularly interesting, or is that just sort of a dead space for now?
It's a dead space. Vuori is going to be coming out. That's going to be the first kind of real competitor. It's a local company around here that's been private and just done incredibly well. They didn't really take many outside investors until just recently. They're talking about an IPO. I don't know why they'd want to be public other than cashing people out, which they can do different ways. This is a great environment if you're a retailer to just kind of pile it up and take share. Not everyone's going to be able to scale that well. And they're not going to be able to provide the growth that you want at the multiples that you need to do the IPO in the first place. So you take a company public at 50 times earnings. I mean, this is not an environment where your retailer is going to justify that kind of love. And so companies are staying private as long as they possibly can. I tell you, though, if Vuori comes out with a reasonable valuation, it's going to be a story. They're very much aping what Lulu did in a really smart way. And that's less about the athleisure. That's less about the stretchy pants or styles, although that's part of it as they're taking advantage of a social trend. But it's really that this is a concept that they're online, they have physical stores, and they're being carried at the Nordstroms and Macy's of the world. And so they're kind of indifferent to where they're making their sales, which is Lulu was the first of those companies. I've been following them for an embarrassingly long time, but they were really the first one to be pretty much agnostic about the channel. And so they can go online, offline. When COVID hit, we all wanted comfy pants, but we especially wanted comfy pants from a place that was going to be able to deliver them and find their inventory. Lulu's been set up all along from inception to be online, offline. And that's the model that's going to work. There's other bitsy piecey retailers, but right now the tide is so far out that your cash flow situation it's hard for these companies to make any real gains. There's a little company called Aritzia in Canada that I've been watching for ages. It's just not clear they're going to be able to make the leap, but it's a fresh concept. And it's one of those stores that you don't have to be Peter Lynch to walk around the mall and notice that half the places are dead empty and other stores are doing well. And for the most part, that's going to be your best first clue for how to invest in retail. Always has been, always will be. But particularly in this environment where people just don't care about the promotions. Under Armour reports this week. It's not going to be great. They will have steep discounts and no one will care just because that's not the shoe kids want.
Is there anything on the macro front that could help improve, prospects across the board for retailers as a industry, or is it just sort of like a trend that's unstoppable in terms of the large getting larger and consumers just not caring so much about everything else?
Consumers, well, they're starting to normalize again. We're seeing more seasonal patterns. Halloween was not bad. Again, you talk about conflicting data. If you listen to the retailers talk, if you're invested in a retailer, you want your management team to be cautious. There's not a ton of downside. You sound frankly kind of insane if you pretend like the economy's great, and you want that sort of rationality. But so you're not seeing this really kind of explosive growth, but you're seeing this, again, the bifurcated market. And in terms of the economic headwinds out there, again, I've watched the way people act. Over the next week, we have Walmart, Costco, Target, or not Costco, they already did report, but Target and Walmart are both reporting. That's going to get you to $700 billion of economic activity in the mainstream consumer. That's a pretty good economic tell. I'm going to be watching those guys, and I think you're probably going to see 2 or 3% growth. Now, that an acceleration of anything economic, just the Fed taking its foot off the freaking throats of people, that would be fantastic for these companies. It would be absolutely, it would help ease things up tremendously. But it's unclear to me, in this consumer sentiment environment, if consumers aren't a little tweaked right now between the news flow and what's happening with their finance, what's happening with inflation, they just aren't paying attention. And maybe super rich people don't pay attention. No one else has the luxury. So, obviously a ceasing kind of this relentless bad tide of news would be great. But at this point, we've priced in a pretty crap Christmas. We priced in really just low expectations across the board. But if you look at things like, there's nothing more discretionary when it comes to spending than Halloween lawn decorations. Those sales were actually pretty strong. The retailers themselves, the inventory is pretty lean. We're set up for a pretty dire kind of post-nuclear dystopian sort of Christmas winter. I think that these companies and the sales are going to be stronger than expected, but they don't really have the inventory to meet the demand. So your two takeaways are shop early and expect these companies to report decent earnings and then be really cautious in their outlook, because being optimistic just doesn't pay right now.
Since you mentioned the rich in that, maybe talk about the differences between sort of luxury retailers and everything else. How have luxury retailers broadly done?
Luxury retailers have been pretty much, you're starting to see it tip over a little bit. But for the most part, pretty kind of immune to a lot of these downdrafts you see with, just in terms of sustaining their margins, in terms of, prestige pricing. That's not a strategy that works in really bad economic times. So it again, that speaks kind of to a bifurcated market. But then again, you hear from Costco and their sales are okay. Their visits are up 1-2%, they reported last month. Is that great? Nope. It's arguably, a downturn. Costco is best of breed, so you figure other retailers are doing worse, but it's not catastrophic. And frankly, you saw over the course of the summer, Macy's took their entire year down. Target took their entire year down. It's basically anyone who had any reason to started forecasting this was going to be a terrible year. So better than terrible amounts to a beat at this point. Expectations are low.
I had put out a post, I don't know, maybe 3 weeks or 4 weeks ago. I was just randomly watching CNBC, and I think it was the Walmart CEO, but somebody from Walmart was basically making the case that, we're starting to see grocery sales drop because of Ozempic. I put out a post that got a little, went viral, something along the lines of, no, that's not why they're not going out. It's because, or to buy groceries, because, cost of an Applebee's dinner costs $60 per dish, right? Something like that. I keep seeing these stories in the media around, it's Ozempic is impacting consumer behavior and purchases. Any truth to that, or you think that's just bullshit?
Total bullshit. You got to write something. I'm sympathetic to the analyst community. Having been in the media before, I realize, it's a new day. You need a headline. But the idea that Ozempic is going to be hitting your grocery sales, you know what? If you drop 30 pounds, you need new clothes. So that seems like it would be bullish for apparel. Even if you buy into the idea that there's a meaningful enough number of people that have doctors who are willing to tell them that they have a pre-diabetic condition to get this ridiculously expensive drug, that is not hitting the bottom line yet. It's could it eventually? Maybe, I guess. All kinds of things happen if we solve obesity as a country. But again, you can't lose 30 pounds without needing new apparel. So you could just go crazy in terms of all these assumptions. But man, it requires drawing a graph that just goes directly up to the right in terms of this is going to be the adoption of this drug. And it's going to have the impact of no one eating and Americans are going to get thin. Not sure about you, but that seems like a promise we've heard before. Maybe it will matter eventually, but not quite yet. I'd bet on Americans having bad habits before I would them getting skinny and stop eating.
Being bullish on obesity is always been a winning trade.
Buy the dip. Exactly. It's anytime you hit your weight target, it's time to frankly hedge by buying the dip in terms of what you're expecting for your weight to do. But honestly, it is just as silly. Like you really would need new clothes. Like really, if people are losing that much weight, they're going to need a series of new clothes. It'd be the best thing that happened to apparel for 5 years. It would bring us back to the COVID age. If you suddenly had people skinny again, man, that would be bullish for yoga tights. It just would.
Is there anything that suggests that, just coming back to this sort of generational question, is there anything that suggests that the new generation of consumers just tends to think differently about having a lot of things? Maybe they're more on the minimalist side. They focus on, sustainability more than anything else. So why waste? Is any of that at the margin impacting longer term trends?
That's more a reflection of kind of a new generation of people being in charge of the media, as far as I'm concerned. We saw something similar when the millennials started, taking things over. And that was no one wanted houses anymore. Everyone was going to live in austerity. What solved that was them getting some money in the bank. I mean, there are times that were more material than less, but buying American obesity and buying our desire to have neat toys, it's pretty much the same trade. We like stuff. We've always liked stuff. And right now you've seen kind of, you had the post-COVID just almost revenge spending binge where people just chucked money at everything. Now you're seeing that start to pull back on the experience thing. All the think pieces at the time, last year's Ozempic is going to lead to everyone being thin storyline was, people don't want anything anymore. We just want to buy the experience. You're still seeing that a little bit, but you're also seeing fewer people at Disneyland. And yeah, I know that's its own political thing, but it's also just a huge discretionary spend that people are choosing to do less of. So you're seeing the super rich and that kind of aggressive venge spending post-COVID wave subside a little bit, but it's going to make its way back into the goods that we were buying. So you can look at the stocks, Restoration Hardware, for instance, which is selling that kind of pseudo, almost super high end furniture type of experience. That stock has just formed a Christmas tree, went straight up and straight back down. Williams-Sonoma, much better operator, selling a product that's not really, they're just much better retailer, but they're still selling $600 coffee machines, which you don't really need. But business is surprisingly strong. And they've managed to kind of go through that COVID shift where they managed to change the way they fundamentally do business and emerge from it a slightly better company. Again, selling super discretionary stuff where if there's a huge recession, Williams-Sonoma is dead. But if you look at that stock, it doesn't trade like a company that's dead. And if you listen to them talk, they're appropriately cautious, but they're also doing quite well in environments that next to Halloween decorations, my $500 espresso machine, pretty discretionary.
Speaking about just being a good operator, any interesting sort of insights on what makes for the likelihood of a particular retailer being a better operator in quotes than others, other than earnings? I mean, what do the best now do from a kind of top-down perspective that others are not doing?
You're really seeing the tide come back on exposing who really went to an online model right now. The dominant players have answered the question firmly: are we going to be a physical retailer or are we going to be online? We're going direct to consumer. That dial is constantly kind of shifting. Nike being a good example of a company that they were 2 years ago convinced that they were just going to be doing kind of really much more exclusive selling, kind of what they did in the past, especially with their shoes, which is only sell to a handful of vendors and control their image that way. And their goal was to go completely online and their own stores. They backed off that a little bit. So operationally, what you're looking for are companies like that are approaching the problem as one that is dynamic. People like the mix of being able to, again, go to the stores, go online, and buy direct from the company itself. You want those three things if you're looking at a retailer that's going to scale. Otherwise, you're talking about just a niche business. If you're only online now, you're going to, unless you're Amazon, basically, and you've got 5 different other lines of business that are swamping the retail operations in terms of generating cash. If you're only online, you're at a distinct disadvantage, and it's really hard to see how that grows. You need that hybrid model to at least have a foot in each of the kind of bins that people shop in, or you're just not going to be able to expand. Because as we normalize, as we get back to a normal mix in this country, decide how many days a week people are going to work, all that has trickle-on effects that impact any consumer-facing company. And the guys that are thriving, look at the Starbucks of the world, look at McDonald's, look at CMG. These are things that no one really needs. McDonald's would not be quite in the same bucket. But people line up at Starbucks wherever they go. It's an entirely different company than it was 5 years ago. Entirely different. The debate that they had right before COVID was over firing employees for kicking out people who were hanging out in the store all morning and not doing anything. They had people in the bathrooms. Remember that? And whether or not Starbucks could get their workers to go clean and do these menial tasks. No one hangs up at a Starbucks anymore. They drove all their business to the app. It's almost impossible to get a coffee if you're not using the app. And that's the way they've been controlling the growth now. McDonald's has gone to much more drive-through operation. You don't hang out there anymore. It's the companies that you want to be long, the companies need to be invested in, have these dynamic models, and they could kind of shift where their focus is to give the consumer what they want now, because it's really kind of a moving target.
On the public equity side, are there certain retailer stocks which look particularly really attractive, really undervalued from your type of analysis, those that you want to unequivocally avoid?
I avoid the Foot Lockers of the world. And that company could come up and bite me in the ass. That's fine. But I'm avoiding the Gap. I'm avoiding these super turnaround story type of names. I don't know that they're short of kind of meaningful changes on the management level. You're not going to see these turnarounds manifesting themselves. I'm still long Abercrombie. I'm still long Lulu and have been for ages. Costco, is super exciting right now. Not even Charlie Munger thinks so, and he's owned the stock forever. It's fine, but it's if you look at the performance of these companies over the last 12 months or year to date, they're actually doing pretty well. Walmart's just kind of having a quiet little 20% a year. Costco's crushing. It's not at an all-time high. Walmart made an all-time high today. Walmart's a really old company. They've been public since the 60s. So it seems meaningful that it's trading worth more now than it ever has been, despite being largely just, they are the economy. If you're doing $1 billion a day in retail in this country, you're a pretty good reflection of the economic situation, and they're doing well. It's an all-time high.
On a more personal note, do you miss those days doing the media runs as active as you were? I had a stage in my life when I was doing that almost every day myself, not to the same extent as you, but I used to be on CNBC and Bloomberg almost every other day. It was exhausting but fun in the moment. But as I look back on it, it's like, I don't know if that really helped me that much.
I don't know if it helps anyone that much. But it's fun. It's nice kind of talking about this stuff again. It's something you can give or take. I don't miss the day-to-day of it, but sometimes I'll be watching Fast, which was a show that we put together, like almost 20 years ago at this point. But I'll see Guy and Karen. I'm Melissa. I'm like anyone else. You talk to your friends. It's cool that you know people. It's you and I have met before in person. I listen to your stuff. It's like, I remember that guy from the Yahoo Finance. Yeah, it's that side of it. You miss it. You miss your friends. It's fun to see them, but no, I don't really miss being out in the fold all that much. I just think that's it's in terms of the retail side, you see these stories just kind of misrepresented, or just the companies being blamed for situations that may or may not be really their fault, and more a reflection of just social taste changing. And it felt like that needed to be talked about. But no, I don't really miss the general day-to-day of it. But you're the man. You're doing this every day. How do you feel about it?
I put a lot of content out, and I'm very loud, especially on X, because there's nothing else I can do as I wait for the cycle to hopefully come the way of my own strategy, which tells you right away how miserable my life has been the last 2.5 years, right? To see the hell of treasuries and bonds selling off, and having to take the pain in the worst bear market in history for treasuries, let alone the failure of risk off to really happen just yet. So I put all this content out there because I'm trying to grow the audience and the reach, and hopefully, the cycle comes my way. But just like with retailers, right? You don't know when the cycle has changed favoring retailers more broadly until 2 to 3 years after the cycle's already changed. So all you can do is just keep on controlling what you control, which is content.
And set your book, and you're like I am, where you've got a very specific niche that you're looking at. And that's just where you're going to make your most money. Is the only edge you have right now are just fresh thoughts. Guys like you and I, we're not going to outspeed the institutions. We're not going to be the first ones to see this. And we don't have to be relying on kind of larger trends. You don't have to be. If you look at the charts of these, basically any retailer over the last 5 years, you see the COVID just death knell in March 2020. And then you see the spike, and basically it's been dead money since late 2021, 22. And there's not a lot that you can do about that. You can short it, you can try to overtrade it, or you can just kind of set up camp and wait for the environment to come back. And if, when the sun shines, you better make your money. But so you're basically farming, in the winter, there's, if you're farming corn in Minnesota, winter is slow. And so you just kind of hang out, mark your time, and keep track of where the industry is going, because eventually it's going to be better. You could throw away a lot of money kind of chasing these bottoms right now, trying to catch that. Pull up a chart of the Gap, go to my X page, and you can kind of see it. I just posted it. you may have been able to catch that 30% rise in the last month, but man, you're down 90% in the last 10 years. And so I hope you were quick. It's for the folks at home trading and kind of marking their own books, doing nothing is quite often the best trade. And that's really the disconnect with the media when you're trying to come up with content every single day. You end up talking about Ozempic as though literally everyone in the street that you run into is on this drug, or that Walmart customers are taking a $1,200 a month drug to the point that they're actually buying less food. That it takes heroic assumptions to kind of come to that conclusion. And that's just people who are generating work for the sake of work.
Yeah, which is unfortunate. And in the context of all these newer traders that entered post-COVID that don't know any better, right? They think that's the way to think about investing in markets, and it's not. But yeah, I on the one hand, I think the media is less influential as it used to be. But on the other hand, just the number of sheer new entrants with zero commission trading and all this stuff, the influence on the number of people probably that are uneducated, about investing is probably higher than ever.
Oh yeah, and it's the get rich quick schemes that never goes out of style. It's SBF didn't make up anything new in terms of scamming people. The truth is, good investing is like fishing, and broadcasting fishing is, we're sitting there looking at a bobber all day. We're going to switch baits. It's a slow moving process, and it should be by design. If you're whipping them around and trying to get that double or playing the ape game, that was really, if you look back, kind of the capitulatory high. I was actually long GameStop going into that. So that way before I should have in retrospect, but it's a garbage company and it kind of had tripled. But that was the death knell. That's the end of a move. And after that, you got to let it rest for a while. There's always a new place to try to flip it and get rich. But man, it's really hard to become the area expert on a brand new niche every morning, just depending on where the momentum is taking you.
I know you had mentioned that you hadn't done sort of long form podcasts in a while. I mean, is your hope to kind of get back in the swing of things on the media side, kind of get more people to be aware of the type of work you're doing on the consumer analysis, retailer analysis side of things?
It's a possibility. I'm open to the idea. I've enjoyed our conversation, Michael. It sort of depends on what the market will bear and opportunities as they arise. I frankly have spent the last few years just for a lot of personal reasons, just kind of enveloped in family dad type of stuff, which has been fantastic. But we're about to be empty nesting, so I'm kind of open to where the winds take me. But it's this is not a comeback moment. Not Elvis in the leather suit here. Just thought we'd have a nice chat.
Dude, everyone loves a comeback story. Come on.
Well, we'll see. Maybe I'll do one of those pay-per-view fights. I'll fight one of the Paul brothers. But in terms of coming back for everyday media thing, not really. But it's I'm not retired or anything. I'm just kind of involved in my own way, which is a nice choice to have.
Everybody, please make sure you follow Jeff Macke here. Jeff, for those that want to track more of your thoughts or get maybe access to either research or things that you do, where do you point them to?
I'd point them to Twitter. I'd point them to DM, and the lines are open. Happy to talk about this stuff whenever as it scales up. Again, the consumer stocks aren't going to be dead forever, and I'm really looking for ways to make money off that. So I'll be amplifying from there. But X, for all its problems, is still the best place to go and rant about your book, kind of your opinions on stocks. Still, the platform of choice. I'm not really sure how to work Instagram, and I'm terrified of TikTok.
I definitely do not understand TikTok. I've been trying to diversify, and TikTok is clearly not the place for me as a fun man.
No, that's the time ticket. It's kind of like magic, man. It's I downloaded it once, and 3 hours later, I just knew how to do some weird two-step dance thing. I've seen a million fist fights. It's hypnotizing, but yeah, that's not my bag. So follow me on X, and happy to talk about the consumer space or anything else as appetite warrants.
Appreciate everybody that joined. Again, this will be an edited podcast in a couple of days, and hopefully I will see you all later. Thank you, Jeff. Really appreciate it.
Yeah, excellent, man. Talk to you soon.
Cheers, everybody.